All right, so welcome to another episode of the Contacts to Contracts podcast. I am Bryan Lovell with my co-host here, John Jones, and today we have a special guest, Pamela Paulson with Home Loan Assist. Pam, thanks for joining us.
Thank you. It's a pleasure being here.
Yeah.
Glad you made it today.
Thank you.
Yeah. So tell us a little bit about what you do in your company.
So Home Loans Assist, we're credit restoration and education. I'm a regional director, and primarily before the pandemic, I would travel around, do my credit FICO trainings for mortgage professionals and realtors, first-time home buyers, essentially teach on credit, because even people in our industry, they don't understand all the ins and outs specific to credit. And it really stems from the outrageous number of errors on credit reports to begin with.
Okay.
Are you aware?
I've heard of that there are mistakes, yes.
There are. So the Federal Trade Commission, actually, they have conducted studies that have shown over 80% of consumers' credit reports contain at least one error that negatively impact a consumer's credit score.
Wow.
That's something I did not know.
Yeah, no kidding. So a question I got to ask you real quick. So originally we got introduced to you, when I say we, our company, because I believe you were helping some of our loan officers do some in-office trainings at some real estate offices. Is that
That's correct.
accurate? Okay. All right. So is that like your primary audience is real estate agents, loan originators? What?
So for business, the referral partners, absolutely, the contacts which would benefit us in our industry would be the mortgage professional, loan officers, realtors. But being from the teaching, I was a teacher back.
Okay.
Yep. So I'm very passionate about educating consumers. Anybody who wants to learn about credit, I want to disperse that knowledge because we're not taught this in school.
Yeah, no kidding. It's interesting, in school they do teach us a little bit of economics, right?
They teach you can get a credit card right when you start at 18. You don't learn economics until you're 22 or 3 and you now realize you haven't paid that card in 4 or 5 years.
You have to pay that card back, yes. Yeah. But I think, they teach us, it's interesting because they don't teach credit, but I remember, I think it was about 8th grade that I took an economics class for the first time. And if you did, I don't know if you did this in your school, but we did stock market simulators and stuff like that. So they teach you all of this stuff about money, except how to actually spend it.
To manage it.
Or manage it, right?
Manage it is the key right there.
Yeah.
Don't take on too much debt, right? So Pam, you help in the way that if we get introduced to a client and the client, doesn't necessarily qualify today to buy a home, what we like to tell people is it's never no, it just might not be right now.
Right.
And then at that point, we could make the introduction with you and you and the client explain what happens from there and how you might be able to put them in a better position to come back 3, 6 months or a year, whatever that time period is, and how that all works.
So any referral that we receive, we do a full comprehensive review and evaluation of their credit. Our systems are integrated with the 3 credit bureaus, so we do a soft pull. We don't require loan officers to send us the credit report. Sometimes there's compliance issues with that, obviously. Yep. So we do a soft pull and just walk through their entire credit profile from top to bottom. We want to identify if there are errors on there. Juniors and seniors, we see people information getting merged onto the credit reports all the time. So it's misreporting information from the bureau at the bureau level and a mix-up of information, at the bureau level and then also at the creditor level. So going through the credit report, we just want to set proper expectations. The whole goal is to either correct or delete the erroneous derogatory information. That's only one half of it, though. The other piece, or the other half, is helping them coaching them on building their positive credit. If they have any revolving credit cards, where the balances are, helping them establish secured credit cards, things of that nature.
Okay.
Well, so your goal is to give them an entire credit education, not just look for the errors or here are some of the things that you could do to improve your credit score, but go in terms of educating, this is how you got in this mess. and this is kind of how you stay out of this mess?
Exactly.
Okay.
So it's giving them a starting point. Certainly, everybody's credit is different. So we would not want them to do anything that would adversely affect them. Paying a collection, most consumers are not aware.
Yes.
Paying an older collection will drop their credit score because it simply is refreshing that date of last activity. It's bringing an older account current. A charge-off, however, different than a collection. A charge-off is when a credit card goes delinquent. It's now a derogatory remark on the credit report. Paying that can help raise the score. So again, it's identifying what is on that credit report and how to best get them in a better position.
So that's kind of a sticky wicket. Like you talk about your credit score could go down if you paid down a collection.
Makes no sense.
It doesn't make any sense. So at what point is it any collection that shows up on a credit report, or is it of a certain age that you would give that advice? Hey, just let that fall into oblivion in a couple of years.
So that's a great question. If it's a newer collection, whether it's that month, a couple months old, our best advice is pay it.
Okay.
But definitely the ideal scenario, pay to delete. So we help the consumer contact the third-party collection company or the creditor and just say, I'm willing to pay this. Will, in turn of receiving payment, will you delete it off my credit report?
Okay.
I have a list of companies that usually will, upon payment, delete. But there are a number of companies out there that will not.
That just aren't going to do it. Yeah.
Right.
Okay.
But anything older, whether it's 5 months, a year, several years, that's tricky. And so without
question, can that be negotiated, that
yes,
payoff?
Absolutely. Okay. So again, we know the companies. We've been
settled
in business.
in full, correct?
Mm-hmm.
Okay.
Exactly.
Yeah, so because you've been in business for as long as you have, you kind of know who's going to be willing to work with a consumer and who is not. So let me ask this question: If I just choose to, I'm just not going to pay this collection, how long until it just goes away?
So there is a statute of limitations. Here in Florida, it is 7 years on most collections, charge-offs, things of that nature.
Okay.
Bankruptcies, as you guys probably know, they can stay on your credit report up to 10 years.
Sure.
Judgments can stay indefinitely. So we never advise clients not to pay. Please understand that. We never do. It can be very...
Nor do we.
There are times when collection companies can garnish consumer wages. I mean, that's or
Sure.
get a judgment slapped on them.
Yep.
So, we just want to go about it strategically so they're not.
So
doing
here's
more
a
damage.
question. If somebody has a collection and that gets sold, let's say 6 years down the road, from ABC to XYZ, can that start the trigger and the clock again
It
on that collection?
absolutely will, but it's illegal because of that statute of limitation law. It goes off of the date that account first went delinquent. So companies are notorious for selling old debt. It's worth nothing. It's literally worth pennies on the dollar when it's that old, but they want some money.
Yeah.
Restarts the date of last activity, but legally it cannot.
Yeah.
So that's when somebody would come to you and you could help
Yes,
them through that process.
absolutely.
Okay.
Yeah, so really the reason companies will do that, or debt collection specifically,
It's
is
worthless to them. They know they have 6 months.
Yeah,
and
they'll
it's done.
buy $1,000 debt for
2 cents.
$25 or whatever.
Right.
If they collect $50 off of that, they turned, some margin on it. So,
Exactly.
Yeah. Yeah, that's absolutely crazy, because I think you're right. The average consumer doesn't know that. And I think the average consumer, they get this notice that, hey, you have a collection, and you forget about it over a period of time because you didn't pay it. And then it shows up again, and all that fear all comes back, right? And that's how those debt collection agencies make money.
It's their tactic too,
Yeah.
absolutely. So, and there's cease and desist. If there are companies that are threatening or making those harassing phone calls, we can help the consumer stop that. And medical, oh my gosh, every time I pull a credit report and I see this just outrageous number of medical collections on there, and the consumer...
Pages and pages.
Yeah, yes. And so, the client or the consumer might say, well, I had insurance, why wasn't it covered? Or I didn't even know, I never received a bill. So there's just, any way these companies can make money. So
Yeah, they'll figure it
education
away.
is huge for our consumers.
Yeah. So what goes into the making up of a credit score? I mean, I'm sure there's a lot of, obviously we've talked about collections, but what are some of the other factors that go into that?
So the 5 critical key components are payment history, That's 35%. That's the largest piece of what's calculated in consumers' credit. And all it is are you paying your bills on time or are you not?
Yep.
Okay? But let's take it one step further. Companies, they don't have to report consumer information to the bureaus. They can pick and choose what information they want to report, how often they want to report. Companies are either set up as a positive contract company or negative contract company. All that means a positive contract company usually is associated with a high dollar risk. So your mortgage, credit cards, a lot of auto loans or
Leases.
Thank you.
Okay.
They will pay to report each month. Were you aware that companies had to actually pay to?
No, I was not.
Yeah. So that's a positive contract company.
So that's why
Some only report to one or two.
Yep.
And you say, why is my score 750 here and 650 here? Because there's obviously one trade line that's.
Well, listen, I got to say so far, I've been doing this for a while, and I've learned two things specifically I had no idea of, and I would consider myself pretty well versed in this. So thank you.
You're welcome. So to kind of conclude with that payment history. So we talked about the positive companies, positive contract. Negative contract companies, they only report the end outcome. So we're talking your cell phone carriers, gym memberships. If you go delinquent or you don't pay a month, they might shut off your service. That'll prompt you to give them a call and make a payment. They don't report that late payment unless it goes delinquent.
So you brought up something about gym memberships. I'm gonna go back to when I first moved to Florida. I had a roommate that had a gym membership. I think he went to, let's say it was Lifestyles maybe way back, or Bally's Fitness.
Okay.
And he did a 3-year contract, signed it. This is 25 years ago.
Wow.
And went one day, walked in with a tank top, and they said, you can't work out here with a tank top. He said, well, I want the membership canceled, and he left. Never went back there. 5 years later, came to me to get a mortgage, and I said, hey, Jimbo. I said, there's a substantial collection out there for that Bally's Fitness, and they were notorious back then, by the way, for doing it. I mean, literally, they would tell you, no problem, tear it up. And it was $2,000. He was able to negotiate it and pay it and move forward to change his score. But today, do gyms, do they actually have your social security number to report? How would they report? Just curious.
That's a great question. I don't know if they actually have the social security, but I've actually seen gym membership collections on there.
Okay. I don't know. I mean, I think 25 years ago, the way they set up a gym payment was probably a lot. I mean, today it's just on my credit card, right? And it comes out of my bank account as an ACH,
right?
Every single month. And it's going to keep coming out every single month until I'm like, hey, stop doing that, right? So anymore, I think a lot of these gyms, they don't have that membership plan.
Right. Okay.
Yeah.
Interesting.
And the reason I wanted to really kind of go in depth with that positive and negative contract companies is simply because when we're educating or going through a credit report with a consumer, we let them know, hey, we understand life happens, especially now. Furloughed people who can't pay their bills, whatever they can do to pay those companies or those bills that we know will be reporting is essential.
Okay.
Yeah. Cool. So, what are some other things that factor into?
Okay. The second biggest piece, 30%, is amounts owed. It's simply credit card utilization. And sometimes our clients will say, well, I got into trouble years ago. I don't have any credit cards. Guess what? They're never going to get approved for a loan. They're missing out on 30% of what's calculated. So it doesn't matter if we get them established with a secured or unsecured credit card. They're weighted exactly the same. It's where they keep their balance. If they have credit cards, we coach them on what to pay down, to what percentage. A lot of my mortgage professionals, well, if I asked you, what is the sweet spot? Where do you think that percentage balance to credit limit ratio is to get the biggest boost in your score?
You better say 30, Bryan.
Cheater!
John's over here giving me smoke signals.
Well.
Hey, look at me! Look at me while our heads turned.
So he's saying 30%. Do you agree with that?
I was actually going to say 50%.
Oh, wow. Okay, you're closer. It's 10%.
Wow.
10%. We have seen scores jump 60, 80, sometimes over 100 points by simply paying down credit card balances to 10% or less.
So 10% of the available credit limit.
Or of the credit limit. So let me give you an example.
So it's like a big tease. They really don't want you to use credit. They throw it out there.
Well,
but
they want you to use it. They just want you to pay it off every month.
Well, I mean,
it's interesting.
$1,000 is 100, right? So 10%. I mean, it's
Yeah.
And again, it's not something that we're saying do this the rest of your life, but while you're trying to get the best interest rates because you need your credit score to be as high as possible to get that approval for a home loan, pay down those credit cards to 10% or less, not at zero. So credit card companies have a once a month reporting date to the bureaus. The reporting date is different than the statement date, different than the due date. So let me give you an example. Let's say Capital One credit card, the due date's on the 1st. The client would call the company, hey, what day do you report? It could be the 5th, the 7th, there's no rhyme or reason, but find out what day they report to the bureaus. You don't want that card sitting at zero because it looks like you're not using the card and you're not getting the biggest boost in your score.
Man, I feel like this is a lot to juggle.
All right, so real quick.
That's why you have me.
So jumping back, if you were assisting somebody and somebody had a $1,000 credit limit and they had, let's say 800, 900 or close to that limit, do you help them maybe try to increase the limit or negotiate that, and that might help?
Yeah. So if they don't have the money to pay down, if they have their credit card established, exactly.
Okay.
Call them, but I always ask them.
It's a solid strategy.
Buy
before,
up, right?
Yeah.
Mm-hmm.
Okay.
But before they just say, hey, do I qualify for a credit line increase? Ask the company if they're going to do a hard pull, because obviously then you get hit with an inquiry, which can drop your score, a couple points, 2 to 5 points.
Okay.
Oftentimes, though, well-established on-time payments, they'll just naturally, the companies will give you that credit limit increase without doing a hard pull.
Well, it's very interesting to me because I think the strategy most of us employ is, hey, I can help you improve your score a couple of points if you pay down some debt. Looking at it this way, hey, can I get an increased credit line? Keeping the same balance you already have could get you
30, 40
the
points.
same result.
Absolutely.
Yeah. Yeah.
I can see you doing the calculations in your head on your own credit cards.
So turning a different question. So when somebody, let's say they report on the 1st, or the payments due on the 1st for a credit card. We know on the mortgage industry that we don't report late until they panic, right? So our consumer says, hey, I can't get the payment in until the 5th. Right? We don't have late penalties until the 15th, and we don't report late until it's gone beyond 30 days. How does that work with different credit cards, and how do you track that, knowing if they're all due a different date, and what is it, a hard 30 days for a credit card?
Most of them. They give you a grace period.
Okay.
So usually it is that 30 days, but again, it's not a steadfast rule, so I always advise the consumer, call the company and find out what their rules or stipulations are.
It just makes me think, like, all the years that I pulled credit and would point out a late to somebody, and they'd say, oh, it was only 3 days late. So, I mean, most people think due on the 1st, if I paid on the 5th, that they're late.
Right.
Yeah.
And the reality is that's not the case.
Well, I think the reality,
late.
too, like, let's just talk about a mortgage payment. If you made, you have that grace period up until the 15th every month where you don't have a late fee.
I used it.
On the 16th, if you were to make that mortgage payment, they're not necessarily going to report it late, but they are going to charge you the late fee.
Correct.
So truly, like on a mortgage, you're going to have to be 30 days late before it starts to show up as a late.
Right.
And let's just add on to that. So oftentimes what I'll see is the consumer, if they go 30 days late, they'll end up making the payment, not realizing now they're getting hit with rolling lates because they have to pay that late payment on top of.
And the next one. Yep.
Yeah.
Yeah. Yeah. It's interesting to me as just, you're pointing out 35% of it is the payment history, and then 30% of it is what are your balance owed on your revolving credit lines, right? So 65% of it, that's a big chunk of it, right there.
It is.
Big chunk of it.
So moving on, the last 3 items, 15% is just length of credit history. It's just an average of all open active accounts. So again, if we pull a credit report and we see, especially around the holidays, people love to open credit cards, store credit cards, get that 10%.
They got a Zales credit card.
Yeah. So we might coach them, you need to go close those cards down. But we don't want the consumer, sometimes if they don't use their credit cards, companies can close down well-established credit cards for non-use.
Yeah.
Credit scores will drop, or if they open too much credit, that's kind of a red flag too.
Yep. Yeah, I had that happen probably 15 years ago. I had an account that I'd had for a really, really long time, had paid it down, wasn't using it at all. And when eventually they closed the account on their side because I wasn't using it and it affected my credit score.
Yeah.
So what's the threshold? So if it's something that's like 2 years old, hey, it would be okay to cancel, but if it's 5 years, you want to keep it? Like, is there a sweet spot there?
We're talking a couple of months. So if there's a new credit card that was opened just a few months ago, we can do a calculation by determining how many points we can get by closing those cards. Anything older than that, 4 months, 6 months, if it's reporting positively, I would not recommend closing the card down. Authorized user, that's another thing I do like.
That was what I was going to bring up.
Okay. So another way we can get big boosts quickly for loan officers and for clients, their credit scores.
It's a trick.
Just just have them, a significant other or a family member can add them on one of their well-established credit cards that with a low balance, on-time payment history, and boom, as soon as that company reports, their scores can just skyrocket.
Yep. So I want to point out real quick, and then we'll ask you a couple of the questions here. But I think what's really important for loan originators to take away, if you're watching this podcast, is a good loan originator who understands how credit scores can affect your borrower's ability to get an interest rate even. This is valuable knowledge to have, because if you're able to work with somebody like Pam and her company, or you have a good idea of this on your own, you might be able to win an extra deal or two by being able to say to somebody, hey, listen, if we did these couple of things in regards to your credit, this is the rate I could get you versus the rate that I can get you now. And I think that working with a loan originator too, who has that understanding and that skill set, is going to set you apart from everybody else, right? I think that in today's lending environment, I say this all the time, lenders are all very similar. We all have pretty much the same products. We all have pretty much the same rates, and we all close loans relatively fast, right? So knowing that as a loan officer, your borrower could get a loan, especially if they're a well-qualified borrower who is going to have a nice down payment, they could get a loan anywhere. When you become a consultant versus just an originator, it makes a huge difference. The other thing I would tell you, the reason you want to make sure you're aligned with somebody like Pamela and her company too, is that complexity in today's lending environment is our friend, right? The harder a deal is to get done, the less likely they are to possibly look at getting their loan done somewhere else.
Yeah, absolutely. I mean, you probably can give us some great examples of somebody that you've worked with probably for a year or two, maybe longer. Again, going back to the number one goal for most people is to own their own home. And whether you've had some mistakes and with credit in the past or some of those issues, that somebody like you can help them sooner than later. Because everybody thinks, hey, maybe next year.
Right.
Now's the time. Why don't you reach out to somebody like you and start working on those things that are going to help you get there sooner than later.
Absolutely.
And instead of just burying your head in the sand and putting it off, I mean, just hit it head on and get it fixed.
Absolutely.
And it snowballs from there. What people and the consumers don't realize is it affects everything that they buy. The rates that they get offered. If they go to get a car loan, I mean, they're drastically overpaying finance charges for everything in life.
Car insurance.
I was going to say car insurance.
What about car insurance?
What about? I mean, it's been a number of years since I've shopped for even a new cellular carrier, but when I originally signed up with the company that I have cell service through now, same thing. They pulled a credit check.
Absolutely.
Yeah.
People with subpar credit, 1 in 3 individuals have subpar, which just is in my industry under 620. They can't get rental properties. Everybody is pulling credit these days. So it's now, and what I love is 6 years ago when I started with Home Loans Assist, people, it was just such a big question. They didn't understand credit. Now I think consumers are more aware that
Absolutely.
they have to work on
Credit
their credit.
Karma, right?
Yeah.
They have access now.
Yeah, you're right. All right, so Pamela, can you share with us just kind of, well, we can kind of close on this. We just have a couple more minutes left, but what would you say your top 5 tips are for a consumer?
Okay. For building credit, okay. Check your credit report. I love what you said about burying the head in the sand. They cannot. So first and foremost, there is, consumers can get a free credit report once a year. Go to www.annualcreditreport.com. You're getting those reports directly from the bureaus. It's free. Do not pay for the scores, though, because they will ask, for a certain, fee. The scores don't matter, but monitor your credit. Even if you go to Credit Karma. Now, Credit Karma only reports 2 out of the 3 bureaus. It's not all the information, but monitor your credit. Look for any errors. Pay your bills on time, as much as you can. If you can't pay your bills on time, communicate with the companies, because
Absolutely.
they just want to know what's happening.
What's going on. Okay.
Absolutely. And probably the last 2 I would say is don't open too many new accounts too rapidly. Again, red flag. Lenders
Which
will
is something
think.
that people do at this time of the year.
Yep.
Here's something crazy about credit. I had a loan officer call me about 2 weeks ago and talking about, as people get older and the American dream, again, is to own your home free and clear.
Yeah.
To own your car outright free and clear, retire with money in the bank,
Right.
and then what happens? They no longer have the need for credit, and they close all their credit accounts.
Right.
I don't even know how you live without a credit card. If you
Yeah.
need to rent a car or get a hotel,
Yeah.
you need a credit card. But we recently just ran into a situation where plenty of money in the bank, everything free and clear, and they're looking to buy a second home, and we're having a difficult time getting them financed.
Wow.
Yeah. Well, I think Dave Ramsey teaches that, right? It's like the Dave Ramsey financial piece is not to have credit
Disappear, right? Yeah.
And the challenge with that is when you have none, regardless of how much assets that you have, you put yourself in a difficult position. What I think you could do in that instance is, if you have significant assets, you could put a secured credit card up against that asset just long enough to get you the credit scores that you need.
I think the fear, though, is somebody's going to get a hold of that information and have access to the card. And I do know that you're able to call your creditor and have them freeze that card, and then you have to sign in and log in to have access to the card. So if you did have a trip planned and you needed to book a hotel, you could activate the card and then freeze it, and rather than just closing it for
Right.
fear that it's
Right.
going
Well,
to be
shoot, I
taken.
think nowadays, a lot of these credit card companies, I know with a credit card that I have, I can freeze the account from an app on my phone.
Yeah.
So you've got some of those like cool tools that we didn't necessarily have 10 or 15 years ago. Today you could look daily at your credit card statement, whereas you used to have to wait for it to come in the mail, which was another way that people were stealing people's identities and credit and all of that stuff. Today you don't even have to get the paper bill to your house. You can use the app on your phone, and you can turn that credit card on and off whenever you want. You leave it at a restaurant, turn it off.
That's true.
Until you can go back to get
Yeah.
it. So you've got some of those resources and tools available to you today to protect you.
I love it. And if any of your viewers, if they haven't checked their credit report lately, I would love to do a free soft pull
Cool.
and review of their credit. So
Thank you, Pam. Yeah.
absolutely.
Yeah. John, any last?
No, I think you covered it.
Okay.
We learned a couple great things today.
Wonderful. Well, thank you for having me.
So, Pamela, thanks for joining us again. Pamela with Home Loan Assist. If you liked what you saw today, don't forget to subscribe to our YouTube channel. Like this, share it with anybody who you think might find a value to it. Again, thanks for tuning in to the Contacts to Contracts podcast. I am Bryan Lovell with John Jones. Thank you again, Pamela.
Thank you.
Thank you,
Make it a
Pam.
great day.